Hello, how are you now? Thanks for joining me on this, what is at about 10 o'clock on a Friday morning. It is the 5th of February. It is the VFS Group Global Macro Fund update for the month of January, and it's a pleasure for you to join me. Now, this will be really, really quick, so I apologise, or, you're welcome. Take it however you want to be. I've just got... We're absolutely flat chat at the moment, which is a really, really good way to be. So you can always tell a good fund manager is completely disorganised, and I think that's where that is for me at the moment now. So that's the situation. I'm just going to get straight into it and just go. A quick sip of coffee, which I've got. First off, an anecdote. I got a Fitbit, which is great. Now, my resting heart rate usually would be about 53 beats per minute. Last week it was at 57. Now that specifically you could attribute that to the volatility that happened. It seems to correlate directly with what the VIX does, and that was proven. That was proven last week with an increase in average resting heart rate of over going up by 4 beats per minute. That's a little bit of stress. Thanks a lot for the Reddit and the Wall Street Bets crowd for adding that volatility into the market, but that's what it's all about. So here is the presentation, and this is us starting the January update. First off, AFSL, everything that you're about to see here is general advice. Please, if you need anything at all, come and talk to me about anything you need to have talked to about. Moving on from the... Okay, now, this is the same thing that I did. I haven't got a new one that's here that's got the 2020 numbers added into it, but, it's only going to be a little bit in there. On average, January is up by 1.2%. February, so that's looking back, looking forward. This is for the S&P 500. Looking forward, 0.2% February increase is the average amount that you usually get from that. So, January was up and was up very strongly. In fact, it was and I'll just flick on to it. It was the first 5 days were the 19th best, and I had this written down here somewhere, if I may. The first 5 days was the best. The S&P was up 1.8% in the first 5 days of the year. That's tied for the 19th best start to the year since 1950. So there is an old adage that the first 5 days of the year, there goes the rest of the year, and so it sets the scene for the tone for the rest of the year. So you should expect 2021 to be theoretically to be quite good based on those numbers. However, whilst January was up significantly, it then had those last couple of days. It's always the end of the month when you just want to draw a line underneath it that it just doesn't help you out. Came off significantly in the last few days of January because of the Wall Street Bets crowd. Now, before I get into that, let's just have a quick look at how we did. Now, this was my year because I haven't spoken to you for a whole year. So my year on here of that same account, that balanced account, which I use as the example. I'll just get rid of my mug here. As 17.05% increase point to point, January 1 to December 31, 2020. So I was pretty happy with that. I did manage to squeeze out an extra couple of percent in December, which was a strong month after being a little bit back-footed from November. That's all we had. So I did manage to squeeze about 5% out in December, which is significant for me because that's over and above what I would be trying to do because that's just going to add volatility in. But 17% is 17%. Really happy with the performance on accounts. Happy to consolidate it as well, which is why I've made some of the moves and some of the positions that I've made. Now, January up 0.5%, more or less 0.47% that I've got down there on the bottom. The last few days just really absolutely butchered me with a 3% pullback in the last 5 days of January. That's the sort of thing that you've got to be in the market, you've got to stay in the market, you just have to cop it sometimes, and that's just part of the deal. So that was it. Our V3 valuation model has shown these are the ones that run the best 5 stocks at any particular time. That's shown a 4.89% increase versus the ASX at 10%. So it's a little bit behind there. A couple of the stocks that are in there, mainly A2 Milk, which is one of our stocks, our picks that's in the top 5, had a bad outlook and downgraded the stock price, that's how it goes. It actually looks like A2 Milk, if I was that way inclined, probably could be a little bit of a buy there. So to double it up, not that that's what we do, but it does look like it's quite good. So look, that'll spring back. I'm confident that that'll spring back and everything will be okay. We are in line with the Nasdaq, which is great after outperforming a little bit earlier on from the existence of this thing. Again, one stock will bring you down, and that being said, one stock will also bring you up too. So we've had some amazing returns. It's there, Melly, Facebook, some great returns. That's in there in our quant strategy. That's in our five. So it's 5 stocks in the ASX and 5 stocks on Nasdaq, and it takes out the best one. It's based on our own little IP that we've got, but tested really well and has been performing really well, and we're happy with it too. It keeps people in market, keeps people moving in the market, and people like it. So switching to global markets and what happened. January, the S&P was down 1.11%, which means that I suppose a 0.5% increase on accounts is actually quite decent outperformance. It was up significantly until the last few days it was there. Let's have a look at month on month where everything happened. So I'm over here in the top right. Small caps, which I will get into just in a bit. Small caps performed amazingly well. It's about that 7% area. Year on year, emerging markets up about 30%. So let's just look at the month. Small caps, you've got commodities, emerging, frontier, and that's it. And infrastructure come back a bit because it had performed so well. But small caps was fantastic. One of my key ideas that I've had at the beginning of the year is to charge into small caps, and that's I'm supportive of that too. So I'm going to get into that a bit more, but I don't really have that much on small caps apart from the fact that you just want to buy them. So that's unfortunately not that. So now the Robinhood side is at the end of the month. It was just really brutalised the returns that we were seeing, and it also the market actually did have a really good proper freak out. Now I won't go into it in too much depth because I've talked about it until I'm blue in the face. But the Robinhood thing, I do honestly believe, as being an old operations person, which I am, and there was a time when I do honestly believe that the market was actually at a bit of a risk of actually having some systemic risk with regards to settlement failure, with regards to counterparty risk, with regards to just failure of settlement. So that was a real situation. I was happy to take some money off the table because of it, compared to, say, the beginning of January when there was an attempted coup, in effect, an insurrection. The largest military power in the world. It turns out that they just walked through the front door and they could, and that was serious. But I didn't sell a single thing, and I held it, and the market continued to march on upwards. So an insurrection doesn't bring down the market, but a bunch of guys on Reddit can possibly do so. So we'll get into that in a second, just with regards to the unwinding and how long that takes to unwind with regards to the leverage, the deleveraging, and the decluttering of the market. So that'll be in a sec. So this is it here. So we saw the rapid degrossing, which is the biggest exiting of longs and shorts over that week last week since March 2020, which was obviously when everyone just decided to get the hell out of Dodge. So that there bang on was the shorts that had to cover. You cover those shorts so that you can because you're at risk, because the short squeezes were going on. So the covering of those shorts was quick and had to be quick, and that's why it was. But also what was mixed in with it was the selling of the longs. So there were just positions. It was just funds, global funds, that just took that week and just said, we have to get out of this market because, and there's a lot of reasons for it, a lot of theories for it. First off, the shorts, you don't want to get squeezed and blow up your entire account, you blow up your entire fund from one short going in the wrong direction with you. But a bunch of guys on Reddit push GameStop up, 1,000%. You're still holding that short. You're dead. That's the end of it. So, but the longs are out too. And my theory went with it as well is that I don't like investing people's super funds into markets that don't quite make sense to me. And I know that that's a little bit maybe hypocritical because theoretically all of 2020 doesn't make sense to a lot of people, the market there, but it actually makes perfect sense to me. That there's a whole bunch of money and stimulus going into the market. There's a reopening trade. It's a health crisis, and there's nothing systemically wrong with the market. So that 2020 made perfect sense to me, but last week didn't really make a lot of sense to me. And it's a market where I just didn't have any real confidence of where it was going to go, which is why I was happy to pull some money off the table and lock in some profits and just go to about 20% cash, which is where I was until a couple of days ago, which was great. A lot better than being at 0.1% cash, which is where I was over the break. That was a very difficult position to be in. The market's going up, which is great, but then you have a little hiccup, and next thing you know, you don't have any cash on the sidelines to buy. So it's we did what we had to do to be fully invested, but now you need a little bit of leeway, a little bit of a buffer to be able to do things. Okay, so down on the bottom right side, you can see that the mania, the call option mania, has gone back into full sway. So there's a small trader call that's the calls to open, and you can see that is absolutely off the charts. Now what you get is and these are retail guys. This is retail trades to open. What you get is as call options get opened, the people who sell them have to. I'm just trying to explain gamma hedging really easily, but it's the people who sell those calls have to hedge those positions by buying stock on the market. And if the calls are out of the money, as the stock moves up, if it does move up, then the people who are the sellers of those calls have to continue to buy more stock to be able to hedge it based on the mathematical principles in which they run. As it goes up, they have to keep on doing more calls get bought, the stock keeps on going up, and that's sort of chasing its tail. What we saw is that didn't quite happen this time, even though you'd think that theoretically it should because of the amount of call premium that's going in. However, when you put those two charts next to each other, the amount of selling and the exiting and the degrossing in the market, the selling of those longs, pretty much met that call option hedging in the market, and it negated itself well. It just meant that there was natural flow. So normality was resumed, normality was restored. My resting heart rate probably going to get back down to 53, 54, and we can all invest with a little bit more peace and quiet in the market as that's gone. I think that the Reddit thing is most probably behind us, that they may find certain things later on down the track, but I think that the trust is there. It's all blown up, that community, and I'm not sure they're going to be able to have the same dominance that they had before. Trading platforms purely just cannot accept the risk that they were offering people in those small cap stocks that with not much money, that they were able to leverage these stocks up and push them right up and cause some serious turmoil in the market. So I do like the idea, I do love the idea, but just too much risk in the market, unfortunately. All right, moving on now. I know that I said that I was not going to play this chart anymore, but here it is. Look, one last time, I promise, because now, since the last time that I spoke, now we've got an actual set what Congress is going to look like. The Georgia runoff race, both went to the Democrats. That was amazing, which means now that there's Kamala Harris is the casting vote in that particular place. So that it's a light blue wave. You've got Biden as president, you've got a House and a Senate which are both Democratic. Now, so we have a look at what it is that we want to do. So Biden, EM, Asian equities and currencies, yes, we're in that. Stronger risky markets, I think that there's something in there about small caps. I don't want to talk about oil, US materials and industrials, consumer discretionary stocks, EM, Asian equities and currencies, inflation break-even, don't worry about those ones, it's too low. Own gold. Yeah, so we're doing everything correctly here. And I think down the bottom, tech sector less clear if the administration favours enforcement actions rather than existential legislative changes. I'm okay being lighter on the tech side. So that's where I stand at the moment on that one. So that's it. And yes, that's sort of where that goes. So it's small caps, it's consumer discretionary, lighten down on tech, own Asia, own emerging markets and emerging market currencies, own industrial. So that's we're in line with this playbook. So that's fantastic. Really happy with that. JP Morgan. That is it. I promise that'll be the last time that I play it. We are in the right direction now. Whatever happens next is somebody else's problem. So now the fund manager survey. I always like playing the fund manager survey here. Go really quickly through it. It was the hold please. It was the where's it gone? Sorry. Now the fund manager survey cash. This is for January. The cash in on accounts has dropped to, this is amazing, 3.9% from 4%, which is that's a sell signal. Which so in January that actually was a sell signal. So it does show that on average, back tested for 1 month, the S&P 500 return is down 3.2%. When cash on fund managers' accounts goes down below 4, actually did prove to be quite accurate because the market did come off quite significantly at about that time. So if you just did it based on that, that's it. Is it based on a very simple theory that with no cash to spend, everyone is fully invested, and that's when the cycle just turns temporarily or for some long-term amount. So in the bottom right, you can see that red circle, that the cash levels were down to 3.9%, and that was the sell signal. So I was in line with those cash levels. Probably actually had less cash than that, and the market did come off. So there's something to be said for that. So Bank of America, they've got some pretty good numbers running in that one, but that's it. Now, tail risk. So the two ones that people always go to. What's the biggest tail risk at the moment? COVID vaccine rollout. I don't think the vaccine rollout has been as bad as it could have been, but I mean, the previous administration showed us just how bad they could run everything, which means that if the most basic level, you know, anything that they do, which is anything that Biden and the administration now does, which is at the most basic level of care, of organisation, will seem like a miracle compared to the last guy. So it's that's really looking good. So I think the vaccine rollout is actually going quite well. It's going quite well in Britain. We don't need it, and if I could just have a little bit of a say on this at the moment, I don't think that we need to rush into having the vaccine or charging into the vaccine in Australia, because it is still being rolled out around the world, and we're still seeing the effects of it. We're still seeing who it can be used on, how often it can be used, dosage amounts, age, health, all of those things. We can sit here and sit back, let all of the lessons be learned, let all of the science be scienced, and be able to roll it out perfectly once it's all set to go. We have a beautiful lockdown economy here, and lockdown economy, that doesn't make any sense, but we've got a great way of approaching this pandemic, and it's anyway, so we've done quite well. Now, moving on, 62% of fund managers survey investors were overweight emerging markets. 2/3 of investors say that emerging markets will be the best top performing asset in 2021. I'm still liking emerging markets. President Biden's number one focus in the first 100 days will be healthcare. Number 2, infrastructure. Number 3, inequality. Fund manager and the survey said President Biden will be number 1, higher taxation. So the solution to higher debt under President Biden will be higher taxation. Number 2, inflation. And number 3 is modern monetary theory. We're not going to talk about MMT today. So, inflation, expectations are at all-time high. January 21, through the roof there. Everyone just expects that inflation will be as high as it can be. So I'm confident with that, and I'm confident to do investing based on those decisions as well. So we see that can go. Small caps, why? Look, putting it really simply and without going too deep into small caps have got the best leverage to the reopening trade. They're the smaller companies, because they're small, they've got the most leverage to it. A big hulking behemoth, doesn't really move up and down as much as it should based on, the reopening of an economy. But the small companies that have sort of battled along, they will. So that's why small caps is the way to go. I like the idea of the weight of money being behind that trade as well. I'm happy to be a part of it. So I've got a small cap ETF that I've put accounts into. IJR is the local listing. It invests entirely in IJR over in the States. It's run by BlackRock. I've got no problem with them. And it's split up very well. The names of the companies aren't household names. You wouldn't particularly know what they are. But it's got industrials,
Order partially filled.
Consumer discretionary. It's got everything.
Order filled.
So I'm quite happy with that. And just to know the small caps well, because stimulus is coming. Well, what do you need anything more after that? Stimulus is coming, but also the reopening trade is hitting as well. There's a lot of reasons to really like small caps. So I'm very, very confident with that small cap trade, and I'm really happy to be in that part of the market. So I sort of took some money off the table in things like in things like quality and tech, which Nasdaq, which were sort of placeholders just for a while to let the market go up. Took some money off the table there and into things here like small caps. So really happy with that trade. Absolutely. Now, food, inflation. Now, this is off Bloomberg the other day. A spike in food prices in China has been put down to a resurgence of the coronavirus, which the country thought it had contained. So not only is rising, this has been my theme. This is exactly in line with what I said would be the case. People get scared of when their food gets tainted. People get scared of this virus being on their food. Food prices go up because there has to be more controls over it. That's just the next natural thing. Remember what I said about meat is too cheap. Never forget that being said by the German health minister, I believe it was. So you'll see food prices continue to go up. That food ETF, I'm really happy with it as well. Now, while I've got it here, I'll just bring it up and we can have a bit of a look at the food. Now, what I've done, don't worry too much about the stop level that's on there. I've just put some stops under things, but that's the food ETF. Continue to go up. My buy price is down here at $5. It's currently at $6.58, so I'm really happy with the way that that's traveling there. I've put stops under some things here too, just because last week I didn't really want to get whipsawed on some things. So just anyway, don't worry about that too much. But that's how that goes. So look, yeah, food still continues to go up. Do your own homework on food and everything that needs to be done around that. It's just food is too cheap and it will go up, and the companies around it will make more money. And also don't forget that the La Nina effect means that we get lots of rain, the US gets lots of drought, so food prices are going to go up because food is going to be growing, crops are going to be scarce over in the States. So great for us, great for food prices, great for investors in the food market as well. So moving on, inflation. Now this is the latest investment that I've made. Don't say I don't give you anything for free. This is the inflation ETF, INFL. It's run by Horizon Kinetics, and it is just a culmination of companies that the people at Horizon Kinetics think will do well in an inflationary environment, which, as I said, Fund Manager Survey says that inflation expectations are at all-time highs. I'm not going to get in the way of that. I don't disagree. You got Texas Pacific, so it's land, it's pharmaceutical, it's stock exchanges. What have we got? Food, precious metals. It's things that go up in an inflationary environment. It's good. The thing is, it's new. It only launched a couple of weeks ago. I would be probably one of the first investors in this thing, and I'm really happy to be. And it is. This is how fresh it is. Actually, I'll throw up a chart here so you can see it. That's it. That's as many candles as there are. 1, 2, 3, 4. That's it. So I picked it up around here, and very happy for that to continue on upwards. I want to hold that forward to 2021 because I think that inflation growth will be the theme of 2021. That it'll be the thing that everyone talks about. Right, rush for time. Let's get it done. Profitable stops. Yes. So what are the changes made that I made? I put the profitable stops on quality and HNDQ, and they got swept away last week or on Monday, I think, in that sort of big correction that came back. And I was happy to see them go because I don't need to have them on. They're not super important to the portfolio. They're not super themed. They're just it's just buying Nasdaq and just buying quality. So they're placeholders. Let the market go up, and they went up, and they did. I added inflation. I added CNYA. That's a view of VFS. That's the Chinese domestic equities ETF. If you want to know more details about that, we've got our China expert in VFS. I'll get you in touch with him. He'll be able to help you out with the Chinese domestic equity stocks. There's some really good names in there too. IJR, that's small caps, and value. I didn't want to talk about value today. That's VVLU, run by Vanguard. It's just a good value trade. So I think that as inflation goes up, well, actually I don't want to talk about value today, but that's a different discussion that's on there. I still like, these are the obvious ones that I've still got on portfolios. I still like 5G. That's an infrastructure play. It's a tech play. It's actually a value play as well. That 5G is definitely has to be a core holding. Food, which I mentioned, I've still got. Google continues to be held across accounts and continues to blow everyone away, and I'm so happy with that holding. It's amazing. Zscaler as well. That stock keeps on going up. I actually did the numbers now. Even with FX taken into account, it's about a 258% profit on Zscaler. So really happy with the performance of those ones. Really happy just to have those particular holdings as they are, and not really do too much about it, and just change a few things around the sides, like letting quality and HNDQ get swept away, and pumping in inflation and CNYA, and small caps into there as well. I think that will be the chat for the next few months, and yeah, you want to be a part of it. So US stocks, new rally after bit of a bumpy ride at the end of January, but everything seems to be back to normal. The natural tendency was to buy in 2020. I think that the natural tendency will probably be to sort of sit on your hands a bit for 2021 and let things go sideways. Don't really necessarily go and charge into the market or that. So the last couple of days, it seems like people have just been going back into risk and buying risk, so everything's sort of back to where it was. Push the market up a touch. Pretty happy with that. So well, I don't really see or foresee any real risks in the future, which is pretty good. The vaccine will continue to be rolled out. The world will continue to spin. The reopening trade is going to be the next thing that happens. The thing about big risks is that the biggest ones you can never really see because they're the most expected ones. I don't see any real big downside risks to this trade. If inflation does pop up out of the box, every single Federal Reserve, every single reserve bank has said that they're not going to do anything about it and just let inflation grow. Usually an inflationary upswing would cause a bit of trouble. Rates would then have to rise, which then would bring markets down. Now, everyone has committed to say they don't care about that. So it's even more bullish for markets. You've got Janet Yellen, who's the new Fed chair. I will never stop calling her the Fed chair. She's the new Secretary of Treasury, and she's bullish for markets as well. She loves printing the money. She loves keeping the interest rates down. We saw that when she was the Fed chair, and now we're going to see it now as she's as she's Treasury Secretary. Biden, nice accommodative president. I keep on saying, people just say, well, doesn't this mean that the US is going to be friendlier on China? No, that is absolutely not the case. You'll see that, in fact, he will keep the same stance on China. The one difference that there will be is that it won't be done over Twitter. It'll be done diplomatically. It'll be done properly. It'll be done procedurally. You'll be able to wake up one day and know that the policy of that administration is the same from one day to the next and not completely made up every day. That's the consistency that markets were after the whole time. Takes the volatility right out of it. See more upswing. Look, that's that. Got a couple of funny tweets that are here. This is what happened last week. This is a scene from Margin Call, and it's the CEO said to tell me, yeah, so I read on some kids about a website. Anyone who's seen the movie knows that scene, but they know that a couple of hedge funds really did blow up last week, and one got blown up, and a couple of other ones down about 50% now just after that 1 week. So that's quite funny. And then the other one was just the way that social media, everything is a meme now. Social media just taking over everything. As a coup was going on in Myanmar, an influencer was doing her her workout class in front of it, had no idea at all that there was a coup that was being commenced in the parliament behind her. So sad crosses over there, but you can sort of see some of the humour in some of these things, just some of the sick, just that the world will just keep on spinning on these things. So anyway, that's all I've got to say. It's a quick one, so that's what's shifting. February, no real downside risks that I can see that's ahead. China keeps on growing, the reopening. If China can't keep a lid on what it's doing with regards to the resurgence of the virus, because they've got a few cases going on over there as well, that could be a bit of a trouble, but I think that they've shown in the past that they're very, very good at doing what they do. And that's it. The US is it's reopening. I can't see anything but, I'm not saying it's going to be tremendously upside. I just don't really see much of a bear case at all. And if that's the case, then you want to be participating in the market. So good luck with that. Now, that's it. VFS Group, as always, portfolio management service that we've got running managed discretionary accounts, trading overnight, trading in the morning, trading in the afternoon, actual wealth management for you. We get involved in a few VC deals as well, which is pretty cool. And if you want to know more about any of those things, please let me know. And thank you very much for your time. And I'm going to go to me. Good. Yes, thank you very much for your time. And I'm James Whelan from VFS Global Macro Fund. Any questions, please let me know. Thanks very much, guys. Bye.